It's 2023 and we're on the cusp of some interesting times in the financial markets. Welcome back to our channel. In today's video, I'm here to guide you through a 10-step master plan to help you navigate a potential market crash this 2023. If you're new here, don't forget to subscribe to our channel for more insightful market discussions. Now let's get started. Have you ever heard of the saying, buy when there's blood in the streets, even if it's your own? Well, that's exactly what we're going to talk about today. If you're watching this video, then you know the market has been on a roller coaster ride lately, and we're in the midst of the 2023 market crash. But instead of panicking, I'm here to tell you how you can turn this market downturn into an opportunity to build wealth. Let's get started. Acknowledge the possibility of a market crash. In the unpredictable world of investing, the one thing that remains constant is change. Change, however, isn't always smooth or steady. It can take the form of seismic shifts, causing the market to crash and leaving investors scrambling. The first step in bracing for such a potential downturn is acknowledging its possibility. Market crashes have occurred in the past and will inevitably happen again. The Great Depression, the 2008 financial crisis, and the coronavirus pandemic-triggered crash are all examples of this fact. When the market is bullish, it's easy to forget that what goes up must come down. It's important not to be lulled into a false sense of security by continuous upward trends. Instead, it's crucial to be vigilant and prepared for any potential downturns. Acknowledging the possibility of a market crash doesn't mean being pessimistic, but rather realistic. It means recognizing the cyclical nature of financial markets. The key is to not let fear or denial impede your ability to make sound investment decisions. Embrace diversification. Diversify your portfolio. This phrase is probably as old as investing itself. But why is it so essential, especially when preparing for a market crash? Diversification acts as a safety net for your investments. It is the process of spreading your investments across various asset classes, sectors, and geographical regions, reducing the risk associated with putting all your eggs in one basket. Think of it as creating a well-balanced diet for your investment portfolio. Just as you wouldn't eat only one type of food, no matter how nutritious, you shouldn't invest in just one type of asset, no matter how promising. In the event of a market crash, if one part of your portfolio takes a hit, other parts could stay resilient, helping soften the blow. Diversification is not about making a quick buck. It's about reducing risk and ensuring you stay in the game long enough to win. If you agree with this, give us a like. Be alert to warning signs. Investing requires constant vigilance. Staying alert and aware of potential warning signs is crucial for successful investing. These warning signs could be economic indicators like inflation rates, GDP growth, employment data, or market-specific indicators like corporate earnings, interest rates, and bond yields. Geopolitical events such as elections, wars, or policy changes can also significantly impact markets. For instance, a sudden surge in bond yields could signal that investors are moving away from the riskier stock market to the relative safety of bonds. Similarly, a significant increase in market volatility could be a harbinger of a market downturn. It's also important to pay attention to investor sentiment, which can often swing from extreme optimism to extreme pessimism, both of which can influence market trends. Staying informed and vigilant helps ensure you're not caught off guard by a market crash. It allows you to adjust your investment strategy proactively rather than reactively, which can make a significant difference to your portfolio's health. If you're finding this content insightful, don't forget to like this video. Stay liquid. In times of financial uncertainty and potential market crashes, liquidity becomes paramount. Liquidity refers to the ease with which an asset can be converted into cash without affecting its market price. Having access to cash or easily liquidated assets gives you the flexibility to act swiftly in a volatile market scenario. Consider a market crash scenario. Prices are falling and panic selling is pervasive. In such a situation, having a liquid portfolio allows you to take advantage of price drops and buy assets at a lower cost. It also provides a buffer to meet any immediate financial obligations without having to liquidate your investments at a loss. Maintaining a portion of your portfolio in liquid assets, such as cash or money market instruments, is always a good strategy. But remember, the goal is not just to survive a market crash, but to emerge from it stronger. Having liquidity provides you with the opportunities to buy undervalued assets and gain when the market recovers. If this strategy resonates with you, don't forget to hit that like button. Go contrarian. Contrarian investing is the investment philosophy that contradicts prevailing market trends. It involves buying and selling in contrast to the prevailing sentiment of the time. A contrarian believes that certain crowd behavior among investors can lead to exploitable mispricings in securities markets. For example, a widespread pessimism about a stock can drive a price so low that it overstates the company's risks and understates its prospects for returning to profitability. In essence, a contrarian investor tries to profit from the herd mentality of the market by going against the crowd. In a market crash when everyone else is selling out of fear, a contrarian would take the opportunity to buy undervalued assets. This strategy requires a strong conviction and a good understanding of the market, as it can often mean going against widespread opinion. However, the payoff can be substantial if the market corrects itself. Successful investors like Warren Buffett have often employed a contrarian approach. If you're excited about this approach, don't forget to like this video. Maintain a long-term perspective. Investing is not a sprint, it's a marathon. It's about staying the course, maintaining a long-term perspective, and not getting swayed by short-term market fluctuations. A market crash can be nerve-wracking, but it's essential to remember that markets have historically recovered from crashes and have gone on to reach new highs. While it's impossible to ignore your portfolio's value falling in a market downturn, it's important to remember why you invested in the first place. Your investment goals are likely tied to long-term financial objectives like retirement, buying a house, or funding education. These goals don't change because of short-term market movements. During a market crash, instead of panicking and making hasty decisions, refocus your long-term goals. The most successful investors are those who remain steadfast, refusing to capitulate to market fears. Remember, time in the market is often more important than timing the market. If you're on board with this philosophy, show your support by hitting that like button. Rebalance your portfolio. Rebalancing is an essential tool in your investment arsenal, particularly during a market crash. It's the process of realigning the weightings of your portfolio of assets by periodically buying or selling assets in your portfolio to maintain your originally desired level of asset allocation. For instance, if your original target was to have 70% stocks and 30% bonds, after a market crash, your portfolio might end up having 60% stocks and 40% bonds. To maintain your desired allocation, you'll need to rebalance by selling some bonds and buying more stocks. Rebalancing helps ensure that your portfolio does not overemphasize one or more asset categories, and you're not taking more risk than you planned. It's also a disciplined way of implementing the classic investing wisdom of buy low, sell high. The essence of rebalancing lies in harvesting gains from asset categories that have done well and reinvesting the proceeds in those that have underperformed. If you're finding this advice helpful, don't forget to like this video. Stay informed. Knowledge is power. In the world of investing, staying informed about market trends, economic indicators, and geopolitical events that could impact your investments is your best defense against a market crash. It's crucial to stay on top of news related to your investments and to understand the broader economic landscape. Reading widely, listening to expert commentary, attending webinars, and participating in financial literacy programs can all help you stay informed. Investment apps and financial news websites can provide timely and relevant information. Staying informed enables you to make well-considered decisions and may provide insight into when it might be time to adjust your investment strategy. Remember, investing is not a spectator sport. It requires active participation and constant learning. If you're up for the challenge and committed to staying informed, show your commitment by hitting that like button. Don't panic. Panic and investing make a poor mix. Panic can cloud your judgment, leading to impulsive decisions that might harm your financial well-being. A market crash can indeed be frightening, but it's important to remember that downturns are part of the market cycle. Like a pendulum, markets swing from highs to lows and back again. Emotional reactions to short-term events can cause investors to buy or sell at inopportune times. Panic selling during a market crash can lock in losses and leave you on the sidelines during the recovery phase. It's important to maintain a level head, keep emotions in check, and stick to your investment plan. The most successful investors are those who remain calm during market turbulence, keeping their long-term objectives in focus. Sticking to a well-thought-out investment plan can help you ensure that short-term market turbulence doesn't derail your long-term financial goals. If you're committed to staying the course, show your resolve by hitting that like button. Be patient. In the realm of investing, Patience is often rewarded. Investing isn't about seeking instant gratification, but rather about the potential for long-term growth. Market crashes can be nerve-wracking, but they also provide opportunities for those patient enough to wait for the market to recover. Patience is about resisting the urge to make hasty decisions during a crash. It's about staying the course with your investment plan, even when the market seems to be moving against you. When the market is down, it can be tempting to sell off assets to limit losses, but this could also mean missing out on potential gains when the market recovers. Remember, investing is a marathon, not a sprint. The most successful investors are those who understand that time in the market is generally more important than timing the market. By being patient, you give your investments the time they need to grow and recover from temporary downturns. So in times of market turmoil, take a deep breath, stay patient, and keep your eye on the long-term goals. That concludes our 10-step master plan to navigate a potential market crash. Remember, investing is a journey. Stay informed, stay calm, and stay invested. If you found this helpful, don't forget to like the video. We would love to know your thoughts and insights. Please share them in the comments below. See you on the next video.